right. Good morning. Good morning. Good morning. We have a big day ahead of us. So I am glad to get started very quickly here today. We have to get ourselves up and ready to go. Up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow. That is a range bar 6. Down in the bottom right corner, we have the NASDAQ 100. That is a range 20. And down in the bottom left-hand corner, we have the range bar 6 Russell. The Dow and the Russell and the S&P are minis, and the NASDAQ is a micro mini. So we're going to watch these markets just a little bit, but we want to put on our iron condor and our wild eye, crazy eye, iron butterfly. All right, so we're going to put one of those on up here on the S&P 500, and then we're going to review the butterfly that we put on yesterday, and I'm going to show you what happened because we tested a bunch of stuff, and I think we come up with a pretty good answer based on what happened. Yesterday was a great market to test this strategy on because it didn't do what we, when you put on a neutral option strategy like the wild eye butterfly, then you want the market to just die and go sideways. And yesterday it did not die. It rallied really hard and it took off and went to the moon. And so it was a very good day to test our strategy of what we're trying to accomplish here with this wild eye, crazy eye, iron butterfly. Now, I think I'm going to have to look and see, but I don't think we made any money yesterday. We made money because we had on dual insurance policies, but typically speaking, you wouldn't put on dual insurance policies because you don't generally expect the market to go to the moon, right? You'd only put on dual insurance policies if you expect the market to go to the moon. And with a neutral option strategy, that's why you put a neutral option strategy on, is because you don't expect the market to go to the moon. So in this case, it did go to the moon. And so our neutral option strategy, and we were testing two different kinds of option strategies or neutral option strategies. So I think we ended up with the real one. Actually, we tested three different types. And so we had three insurance policies on. And so I think we made money. Oops, I think we accidentally made money because the market really took off and rode hard. I got pictures of all this stuff, and we're going to go through and review it. And so just hang on here for a minute. We're going to wait for the opening bell to ring, which will ring here in 1 minute and 53 seconds. So we're going to watch that, and you can see that little countdown timer on the S&P 500. That's the one that's counting down until the opening bell because that's our minute chart. These others are range bar charts, so they don't have time involved. They're just the trend. But up here, this is a 2-minute chart. And I got to drink some tea. I'm losing my voice, so I don't know how long we're going to last today. We're trying to get as much work as we can before I lose my voice. Boy, the allergies are going banshee here. Really crazy. Some reason I don't know what it is, but boy, my allergies are going crazy. Plus, I think I caught a little cold. I don't know if it's a cold or if it's the allergies. I think I caught a little cold, so I'm fighting allergies and a cold at the same time. So I apologize if you have to stop and give me a chance to drink a little tea once in a while. All right, so the market's getting ready to open up here. We got 38 seconds. You can see on the S&P that little countdown timer right there. So you can see a little countdown timer. It's getting ready to 30 seconds till the market opens. Look what the Dow's doing. The Dow has been the superstar with our day trading lately. It's the one that's really been just unbelievable. All right, unbelievable. We need to, if we're going to day trade that, we probably want to have on our ATR stop. We could use that. Wow, look at it go. Look at it go. Look at all the arrows. We got too many arrows. We got the purple one is the VWAP, so that's just crossing the VWAP. The red one is the bulls and bears, telling us the market's changing from the neutral zone of the Fibonacci sweet spot to the bullish side or to the bearish side. That's what the red arrows are. And then the yellow arrows, those are the ATR that I just turned on. So those are trying to help you identify when the market's changing bullish and bearish based on the average true range, which in this case is set to 1 and 0.7, so pretty aggressive. The Russell looks like it wants to be a little bit aggressive. Look, it's been pretty smooth here in the pre-market session as well. We're going to see what happens here. The bell just rang, right? Yeah, bell just rang. So that's the morning bell. Let's let it settle down for a second, see what it's going to do. We need to look at the news and see what news catalysts are going on today. And I looked at the news, and there's nothing. Initial jobless claims came in at 6:30, which is the one that's going to have the biggest impact on the market. You can see down here. Let me see. Let me bring this thing full screen so you guys can see a little better. There we go. So you can see down here, this is the only news we got all morning, Thursday. Nothing. No reds, and we've got 4 darks, and those are 2 impacts. This is UTC 6, so you're going to have to make adjustments for your time frame. But you can see in here, this is all at 6:30. So that's it. Nothing. So 220, 229. So that's actually bad news. 220 was the forecast. We had 200. So 9,000 more people are out of work than were before. So 220,000 versus 229,000. They were thinking it was going to be 220,000, but we got 229,000 claiming jobs. They lost their jobs. All right. So let's see if there's not an opportunity for us to, one, either put on our iron butterfly, wild eye, crazy eye, iron butterfly. And I'm going to show you the difference of what we did yesterday. Well, let's go talk about it yesterday before we put it on, because we got to know what happened yesterday so that we can know why we're putting on what we're putting on. Okay, so here's this first screen. I got a whole bunch of screenshots. I don't know if we need to look at all of them, but here's how we set it up. This was, why is it doing that? Come on. So this is how we set it up yesterday. And how am I going to do this? The boys helped me. I got this figured out. I can put me in this. I think I can put me in the center now. Watch this. Oh, well, that didn't help. They put me in the center, but now you can't see the chart. Well, that didn't do any good. I guess we'll work on that one again. All right. So here we go. This is, let me put me over here. I think that would be better. You can see I want you to see the dollar amounts. So how do I get over there? Like that. Okay. You still hear me? All right. So that is how we set it up. All right. So we set it up so that we had it on 2 separate tickets, and we put the calls on one ticket and we put the puts on another ticket, which is unusual. That's not how we usually do it, right? But I was trying to test something, so we're testing the deltas on these. So we're testing the deltas once again, and we did a whole bunch of testing, and we put all the deltas either at the money or out of the money, didn't we? We did a whole bunch of that, and then we did a whole bunch of theta testing. And the theta testing, we determined that we need a shorter term theta, which is the days till expiration. A shorter term days till expiration is better for our insurance policy, but we want it to be not too short. I mean, I was using 1 day yesterday, and that worked out pretty good. We could do 2 days, 3 days, 4 days, 5 days. Any of those are fine. The further out you go, the less sensitive the market is to the current day's trade. So if you think the market's going to go crazy, you want to have it closer in. If you think it's going to be pretty quiet, you're going to push it a little bit further out. If you push it further out, it costs you more money, but it's more stable, and you'll lose more money. Yeah, you'll lose less money over time. So it actually loses less money because it's more stable and it doesn't decay as much of your time decay. But if you think the market might move hard and you want to put this strategy on, you want to move that theta very close. There's no one answer that's best for everything. The problem is you don't know what the market's going to do, so you have to do kind of a happy medium. So 1 to 2 days, 3 days, 4 days, 5 days, somewhere in that range. And I like to go to the quarterly. So whatever's inside that range, if there's a quarterly, like if let's say, I want to go on 2 days out and put my insurance policies 2 days out with 2 days till expiration. You want to go to the one, but then there's a 3-day that has a quarterly expiration. You probably want to choose the 3 days, okay, because you want to do the quarterly expiration if there's a quarterly expiration within the 5 days. And then sometimes you don't want to go out over a weekend either. So if the Friday's coming up and you've got a quarterly on Monday, but you don't want to go out to Monday because it's over a weekend, then you're going to choose the Friday expiration, all right, which would be the 3-day or the 2-day expiration for Friday, so you don't have to hold it over a weekend, all right. but then that wouldn't be a quarterly expiration, and that's okay too. So you just have to kind of massage it a little bit and decide what you want to do. And if there's no quarterly, you're just going to go to the weekly expiration that has the most volume and the most options, so you can get the tightest spread. That's important. But then beyond that, the next question is you're going to want to choose whichever one of these is going to be uh, more in line with what you think the market's going to do that day. So if you think the market's got you want to put your option strategy on, and you think the market's going to, where's our little, if you think the market's going to have a big move because of the news event, right? If we're going to have a news event that's a red news event, and you still want to put it on, usually we don't put it on if there's red news events, or at least wait till the news events are over, right? So if you're going to put it on and there's a red news event or a news event coming up, you're going to want to have that as close to one, probably right down to 1 day, because you're going to want to have a lot of insurance to protect yourself against a big move in the market. So 1 day's expiration on your insurance policies, on your wings. All right. So that's how the theta is working. And I probably ought to document that, because that's a follow-up on, we talked about a little bit in Pit News Magazine. I documented all this stuff in Pit News Magazine in the June issue. And if you guys have not seen the June issue of Pit News Magazine, where is our June issue of Pit News Magazine? Here it is. So those of you who have Pit News Magazine, this is the June issue. And here's the Wild Eye, Crazy Eye, Iron Butterfly article right here. And we went through and we documented this whole thing. So here's how you set it up. Now, this was when we were going through, and this is all the stuff that we did as we documented this trading strategy, right? And then we wrote it all up. We talked about why it's working. This is kind of like the puzzle pieces. This is where you're getting your profit on the short term and your profit on the long term, and those two fit together. And that's why this works so well. And then this is kind of explaining how options work with the delta and the theta. And then, of course, this is a single leg, so you can see why one leg works and then the other leg would be the same on the opposite side. And then this is just some examples, and this was my summary. And if you remember my summary, we came in, we talked about in here the long straddle and the hedge against it and how that all works. And so this was all documented in Pit News Magazine. Now, this month's Pit News Magazine, the July issue, I think I'm going to continue with this article and continue on with the new things that we've discovered, right? Because we've been doing a lot of testing, the things that we've discovered and that we're going to do as a continuation. And I think I need to put that theta discussion in here. So I'm going to make that note on which one of the options we need to. Oh, I just dropped my pen. So theta, and that's going to be our insurance policies, right? So in the money. So the testing that we did where we put the insurance policies, we've been putting them all out of the money. Well, yesterday in our class, we put them in the money, and we haven't done that before. And I wanted to do that because of the skew, the put skew. Right now, let me come over here for a second. Michael Bruce asked yesterday in the notes, he said, hey, what is the put skew? Can you explain that in a little more detail for me? So out in the notes yesterday, or in the comments yesterday, I gave an answer to Michael Bruce about put skew. So what is the put skew? The put skew makes puts more expensive when you buy them, because people buy them more often, because they buy them more often as they buy them for insurance for the long side. So they get into the market, they do basically a married put, right? We talked about married puts, and that's the put skew. And that's why we talked about married puts, because I wanted to explain to you what a married put was, and that's what causes the put skew. So if you come in here and you go to both, let's go to both in here, you can see that we got 2004-37. And these are pretty right darn near on top of each other. And that's good. You like to see that when you're doing a neutral option strategy. You want to see those the same. But most of the time, when a market's a little bit active, you'll see that put option is more expensive than the call option. And that's called put skew. All right. And that's because people are scared. Remember the skew of the market? We looked at skew the other day. We went over and looked in the stock market, and we looked at skew. And as the market starts to rally, people get scared. So they start buying put options as protection to their long positions, right? A lot of people don't want to get out of the market because they have to pay a higher interest rate, right? If you do a short term, let's say you're in the stock market in the S&P 500 and you keep jumping in and out, in and out, in and out, in and out, and you make money, but you have to pay a higher tax rate. You have to pay, like, I think it's right now it's 28%, right? 28% if you get out within 1 year. But if you hold it for one full year, you have to pay, when you get out and take your profits, you only have to pay 21%. So it's short-term capital gains versus long-term capital gains. So any capital gains that you hold over a year's period of time, it goes from 28 down to 21. And they do that. The government does that to try to encourage you for longer term investing. So we don't have, big crashes in the market because everybody pulls their money out. So they would rather not pull their money out. And that's the incentive. That's why they did that. It's like, let's not run the market. Let's not have a run on the market and pull all your money out. So they said, if you do that, we're going to charge you a higher tax rate. We want you to leave your money in. So if you leave it in for more than a year, that makes it so you don't have these big runs on the market. And so then the problem with that is that then people want to pull it out, and they don't pull it out in the market when the market goes down, so they lose money, right? So they don't want to pull it out to get the higher tax rate. So what they do is they buy put options instead. So that's what that skew was that we looked at over in the stock market. So the skew tells you how many people are getting scared that the market is going to turn and flush, so they start buying more put options, and that's why that line goes up on that skew chart. That's why we call it the skew. All right, it's the put skew. So that's why the put options become more expensive. Now, if the market looks like it's going to run, and the majority of traders believe the market is going to run, then they're going to start buying call options, and call options are going to get more expensive. So right now, what we've got is a situation where the market looks like it's bullish. So you can see up here these are the 15 days. You're going to see a more, let's come down to 1 day out. You're going to see a little bit different picture, a little bit more aggressive. So there's 1,050 is what the call costs. 1,012 is what the put costs. So that's because the market's rising and people are buying the call options, right? So look at that market go, man. That's beautiful. We should be trading instead of lecturing. But that's what the put skew is. It's the cost of the put being more expensive than the call at the same strike price, and that's represented in that skew chart that we talked about on a previous video. If you didn't see that video, go back and look. It's titled VIX and Skew. Watch that video again, and it'll help you understand what the put skew is. So because of that put skew, oftentimes when we're put on these iron condors, that put skew gets wacky, and that's what causes us to lose money. So we lose money because of the put skew on this neutral option strategy. So we've been trying to mitigate the loss of the put skew. And so that's what we've been doing. And I'm going to document that in Pit News Magazine. And that's the point of this conversation. I'm going to continue that. And if you don't have Pit News Magazine, go get it, because in the next issue, I'm going to document. We've got Delta. We're going to talk about Delta, the Delta skew, the put skew, the theta, and the convexity, and how that's affecting our option strategy. Now, yesterday, again, we had this option that we put on. And so this was what it looked like when we first put it on. All right. So this is when we first set it out. And you can see the 0 days till expiration, 35.25, and the insurance policy we put up here. Now, here's what we did differently. Usually we'll put the put and a call on one ticket, and we'll put another put and a call on another ticket. Yesterday, I did reverse. I put both the calls on one ticket, and I put both the puts on one ticket. And then I put and a call on one ticket as an insurance policy. Now, these down here, you can see, are not meant. Let me try this. Get up here, Land. There. So these, I want you to be able to see this, because this is important. It's a continuation of our conversation yesterday. So we put these on, and if you didn't see yesterday's video, go watch it and then come back and watch this. Well, we're live right now, so stick with us here, and then you can go back and watch yesterday's. So this is the insurance policy that we put on. This is the extra insurance policy. So I want you to watch that and pay attention, because as we go through the slides, you're going to see the difference in price between the two calls. We sold one, we bought one. The two puts, we sold one, we bought one. And then the extra insurance policies that we bought, a call and a put. All right, so those are our extra insurance policies. Now, these are not meant to be in there independently, and we're not going to do that when we do. This is just a test, and this is a substitute. So we're going to say, well, which one is better, this call on the substitute or this call up here on the actual order. So this is the actual strategy right here. This is what we'd put on if we were going to do it in the real money. We wouldn't put this one on. Not that you can't. You can. It's just an extra. You bought a call and you bought a put, so it's just an extra straddle. So we added an extra straddle. So that's what this is. It's a straddle and a strangle. All right, or it's two straddles broken into. It's actually a straddle and a strangle, but one's got it's a calendar straddle strangle. So that's why it's weird. It's like, what are you doing? This is not something that's traditional. That's why we call it the wild eye, crazy eye iron butterfly, because it's not an actual butterfly. It's a weird thing. All right. And so we had to give it a new name. So these are substitutes. So down here, you can see these are substitutes. So this buy call substitutes out this buy call. Which is better is what we're trying to find out. Was this one better or was this one better? Was this put option that we bought better or was this put option that we bought better? And so these are the substitutes. So that's what we're looking at here. Let's see. We're going to close this one down and go to the next one. Okay, so this is a little bit into the market. Again, I got a whole bunch of pictures. I don't think we need to look at all of them. But this is how the market took off. And you can see it started to rally. It broke above the center line right there. And man, it took right off. And it just left. And so what happened is when you have a neutral option strategy and the market takes off and runs, well, you need to have an insurance policy that protects you against that. And so that's what the buy call and the buy put are supposed to do. So you can see in this case, this is our actually strategy. Again, this is our swap out ones, substitutes, which one would have been better. So you can see we got the buy put is losing 225. The sell put that it's supposed to be protecting is making 230. So you can see that worked pretty well. We only lost $25 at that point, even though the market ran like a crazy wild banshee, right? And then the same thing up here. You got this position with the buy the call and the sell the call. So the buy call was at 375 and the sell call was at 365. So then you have to ask yourself, well, which would have been better? The buy call here or this buy call? This one way out here on the bigger wings out on the edges, or the ones that are closer in? Well, in this case, the buy call here was 350. This one was 375. So the closer one in was actually better at this point in time. It was doing a better job of protecting us, was making more money. This one has a longer time to expiration. See, this one has 1 day till expiration as well. So it's the same. The only difference is where we put it in the money. Now, these are both in the money. See, here's our neutral zone right here. So can I draw on this thing? I should be able to draw on it. Markup. This is, who invented this software? Do I even need to design? Why did it shrink it in size? Okay, see that's where we put our sold options. And usually we'll put the bought options at the exact same price, right? We'll either put them right at the money or we'll put them, wings way out on the edges. So out here. And that's what we generally do. But we've been going, bringing it in, right on top. And now we've actually gone inverse. And we've actually started putting our insurance policies on the wings, which are generally out big wings, right? When you do an iron butterfly, you put wings way out high. And then we start bringing them in closer until we put them right on top of each other. And then we'd push them out. When you put them on top of each other, that would cancel them out. You can't do that, right? 0-0 on your days till expiration. That would just close the position. So on our insurance policy, we have to put it out a day. And so in doing that gives us additional theta. So our decay doesn't go as hard either. So that's good. And now I started to go in the money. Boom, 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 boom. So I've actually inversed the butterfly. So this is actually an inverse butterfly where our wings are actually in the money. And this is how far in the money. So this is the normal one that I've got on here. You can see the small ones, the close ones in right here. Those are in the money wings. So that is a put option, which is generally down here. I've pushed it. Not only have I pushed it up to at the money, I've pushed it into the money. And the same with the put call option. Usually it's up here. And I not only push it down to break even, not down to the at the money, I pushed it into the money. And then I pushed it, not only did I push it into the money one strike, with these orders down here, I pushed them into the money 2 strikes. So that's what we're testing here. We're testing, is it better to be 1 in the money or 2 in the money? One in the money, two in the money, two for the money, three for the money. What, isn't that a song? All right. So I know this is getting complicated. Oh my goodness. Oh my goodness. Who invented this stupid piece of software? Do I have to do everything? That's why I own an engineering firm. So if you want something done right, you have to do it yourself. All right. All we want to do is draw on it, people. Just let us draw on it, okay? So now this is where the market went even further. Okay. So this is just throughout the day what these things look like. So now the market is way outside of our bands, and you can see which ones are making money. So this is the substitutes. These are the actuals. So the sell to put made 400 and it's covering 467. That's why we're down $67. This was actually a very good example because the insurance policies have not been paying off well for us when the market broke out and ran, right? That's where we lose money. So we're trying to keep from losing money on these strategies. So even when the market breaks out and runs, we still want to make money. I know, crazy, right? So here's the buy call. We're making 662. We're losing 652. So that one strike in the money wing is doing really well. This is the two strike in the money wing, and it's 650. It's not doing as well as the one strike in the money wing, which surprised me, actually. It did. I thought that because it's got a higher delta. It's got a higher delta. It should make more money, but it didn't. Okay, because we're still barely an hour into the market. All right, so that's what happened there. And we're going to the next one. Hold on, I gotta drink some tea. Give me 1 second. All right, so on this one, I zoomed out and drew in our cone of probability. And this is how this turned out. So that's what this is. You can see how far outside the cone of probability of the cone of, this is the delta cone of profit is what it is. So this is where when you first put on a neutral option strategy, this is where your loss zone is and your profit zone is. The profit zone at the beginning is very small. So as the market wanders in and out of that thing, it's going to lose money. And I've talked about that before. What happens is you get guys that are on the internet out there and they put on these, oh my goodness, would you stop that already, you dumb piece of software? Who invented this PDF thing? Adobe? I got to come and work for Adobe. I got to just come and tell you guys how to design software because this is a piece of crap. I can't understand how come you'd do it like this. What are you doing? What are you doing? I don't want that. I just want to draw on it. Come on, people. They're not going to let me draw on it. Here's a draw. Okay, can you? Now, why are you doing that? Why are you blanking out? Why did you make the chart smaller? I don't want the chart smaller. I just want to draw on it. All I want to do is mark on it. Oh, no, now I hit this and now you make it small. Why did you do that? I have to do everything. I have to design every software. That's why I own a software company, because every time I got somebody else's software, I was like, what are you doing that for? That's the stupidest thing in the world. You got to do something, you got to do it yourself. So then I started my own software company so I could design my own software so it would do what I want. Now I got to go and I got to take over Adobe. And that's all there is to it. It's such a dumb program. I have to come and tell them how to make it. All right. Sorry. That's my pet peeve. That's why I own a software company. All right. I have to do everything. I'm a design engineer. I have to design all the software. I have to redesign everybody's software. And I see it doing something stupid. I have to tell them how to I just have to go design it myself. All right. So when you do a neutral option strategy, in the beginning, as the market moves back and forth across that, it's going to go out and you're going to lose money. 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 And eventually, right, the whole idea is that it comes into and you make money. But in the beginning, this is all loss territory, right? You're going to lose money if it goes in here. But as long as it comes back into that green zone, you're going to make money. And I see a lot of guys that comes out here and they get out of the market. They exit out here. They're like, oh, I'm losing money. Or even right in here, they'll exit out right there. Oh, that was a bad trade. I lost money. No, you didn't. You just was outside of the cone of probability for a little while. Just wait for it to come back in. The problem is sometimes it doesn't come back in. Now look at this. I'm going to try and erase the drawings. But if I hit erase, what is that? Why did you change the size of the eraser? And now when I erase, what's it erasing? It's not erasing my drawings. I'll go back to markup. Is it gone? No, it didn't erase anything. Erase. What is this? Go back to markup. You tell me. Is that the stupidest piece of software you ever saw? That's not Adobe. That's Microsoft doing that because this is the Microsoft viewer of a stupid. Recent changes will be lost. Well, that's kind of the idea. I don't want them. I didn't want them. That's why I tried to erase them. All right. Sorry, guys. I guess I'm going to have to take a lesson on Microsoft to see how you're supposed to draw on an image. All right. So here's our markup. This is the next one. You can see that now at this point, our buy call is $837 and our substitute buy call is $850. So now that the market has moved farther away and it never did come back. See, that's the problem. Sometimes it never does come back. I don't even want to try and I don't even get it. I hit the draw thing and it opens up a web page. Why are you opening up a web page? I just want to draw on it. Isn't that the little draw thing? Edit image, designer online. Create with Microsoft Chip Checker. Personal note. Where did our draw thing go? Oh, right there. Okay. Now markup. Okay. All right. So this market never did come back down into the green zone. That's the problem. So when the market never does come back down into the green zone, then we have to have insurance policy that covers us so we don't lose a whole bunch of money. And the question is, which one is better? Is it this buy call here? Is that better than this buy call here? And in this case, the market moved out. You can see it's moved out several hours. So we got $850 here, and we got $837 here. So it's only better by $20, right? And it costs us more money. So in fact, it costs us $2,000 for this insurance policy, whereas this one cost us not too much, $1,000. Let's see, the buy put was $600, and the buy call was $800. So 8 plus 6, about the same, wasn't it? Didn't even cost us all that much less. All right, so let's go to the next slide. So now the market really ran out, and now it's starting to look like it wants to come back, right? It looks like, okay. It looks like it wants to come back in. So at this point, we're kind of maxing out. We're kind of topping out. The market looks like it's hit as high as it's going to go for the day, and we're kind of peaking out in here, and it's starting to make little signs that it's coming back down. So that's why I took this picture, because it looks like we're coming into the expiration. And you can see down here again, this is our call, which was $987. This was $962. So it only gave us $20 extra on the upside. And then on the put side, I wish I could make that bigger for you guys, but they keep shrinking it when I draw on it. Oh, look, there's another eraser down here. There's two kinds of erasers. Remove markup. Maybe I'll try that one. All right. So then the put option. So this put option lost $742. And this one lost. So buy a put, $607. So that one was actually buy the put, lost 607. This one lost 742. So actually, because it had a higher delta, it lost more money. That makes sense, right? This one didn't make as much, but how did it compare against this put? So the sell put here against the buy put here was 507 on the sell put, but it lost 742. So that's a $200 loss right there. 5, 6, 7, about a $40 loss. Whereas this one lost only $100. And you can see it right there. Look, click that. Remove markup. Do I have to touch it? I do. Oh, we figured it out. Okay. So now land feels better. Figured out how to do it. This eraser doesn't work. Don't use that eraser. Just use this eraser. You got two erasers. Okay. So Again, this is an example of where the further out of the money option didn't work for us as well as the further closer in the money, but it shows a profit of 245 against each other. So that 245 is covering the losses of our traditional butterfly. That's why we're up $105 because it's an extra insurance policy. So that lets us say, hey, look, if you think the market's going to run, you can put in there an in the money. It's going to be an in the money strangle, right? It's not a straddle, it's a strangle because the insurance policies are not on top of each other. And when they're on top of each other, that would be a straddle. But when they got a gap between them, that'd be a strangle. Well, usually you buy one up here and buy one here, and it's got the gap this way, you're out of the money. But we're doing a reverse strangle and actually putting them in the money. And it's just how far in the money we did it. And this one made $245. But again, you think, oh, that's great, made $245. But look at how far the market had to run for that strangle, in the money strangle, to make money. I don't know if we'd have had it out of the money strangle, if it had made any money at all, it probably still just lost money. The only reason that made money is because it was in the money and it had to really move. That was a blast off move yesterday. It doesn't happen very often. So you're thinking, well, I'll just put those on all the time. I don't know if that's a good idea because the market doesn't run like that very often. More often it's dead, right? So, Lan, just tell me the answer. What did you come up with? What's the conclusion here? Well, let's look at one more. What did you decide after all this work? This is where we closed the positions out. So you can see where we closed them out. Yesterday we ended up with, these are our profits that we made. So we got 875 and 700. These are the closed out. And then this is where we closed out 137 and 87. So after all of our goofing around yesterday, but we counted 2,152. So that's not really, I got one more slide here. Let's close this one. Let's see what the final say was. It was just these. Oh, I opened up the whole thing. So the whole thing was 2,152, but that was that 1625 from the previous day. So in our spreadsheet, that's already been accounted for, right? Because we closed that out. And I didn't hold this overnight this time. Maybe I should have. I mean, because the market's running like crazy. It would have probably made money again holding it overnight, but I closed it out. So yesterday we took this into consideration already. I wanted to close out the month. Oh, that's the wrong month. Here's June. So that's the $900 right there that we already took into consideration. Close this. That's that. $1,625 is what it shows. But remember where we had that zero bought put, which I don't think was zero. So when we closed it out early, it was actually $900. So we took it off at $900 and it gave us $1,625 because something went bonkers with that put and it went zero because this is a demo account. And I think that was the reason why. So I think something went haywire on that put option. But anyway, 1625 minus whatever we had on the put side, which we had the number, which come out and be was a total of $900. So we put it in at 900 at a limit. So this isn't really 2,000. So that's how that all came out. That's why that number's that way. So that's why that is not. We have to go back and adjust it here. So we're going to go back to this previous screen capture. And the previous screen capture just shows the two that we closed out at the end of the day. And then the one that was a 1 day. So that's the big one right there. So it made 175. So that was the out of the money option at the end of the day when I closed it out, made 175. This one we had this one here is the sold put and the bought put. So you have the 87 plus 137 plus 12 and 5. So that was the sold call and the bought call. See that? After all was said and done, because it was a 1 day until expiration, it still made the insurance policy, the sold call and the bought call made $10, $8, but it wasn't enough to cover the loss of the other insurance, but it made money. So it overall we made another. Let me get my calculator out. So if we had to put this iron butterfly on, and without the extra insurance, we had 87. Let's see. 12, can't type, 12.5 plus, let's see, minus 5 plus 137.5 minus 87.5. We actually made $57 yesterday. That strategy would have made $57. After that market moved outside of our cone of probability that far, we still made $57. So we're going to come in here and we're going to put in our note. So we made $57. That's pretty impressive, actually, believe it or not. For a neutral option strategy to still make money and the market closed way outside the cone of probability. That's pretty cool. Okay, so we're going to come in here. We're going to make a new note. So we closed out an iron, a wild eye, iron butterfly with one what was it? Thinkland, how did you set that up that made money? It was one strike in the money on the insurance policies, insurance wings. Close out a wild eye iron butterfly with one strike in the money insurance policy for a profit of $57.50. How about that? Even though the market ran like a wildfire and closed outside our cone of probability, our cone of profit, our delta cone of profit. So we made $57.50 on a failed butterfly. We tested against a 2-strike in the money insurance wings, which in the end profited us another, how much do we make on that? Another 7,875, take 100 off that, so that's 175. Another $175, which is a disappointment, actually. That should have made a whole bunch of money. And so that tells you not to put those on. And the market ran like crazy. And that little straddle, or strangle. No, straddle. It was an in the money straddle. It made $175. That's all it made. That massive move yesterday, that little straddle only made $175, which means that if the market wouldn't have moved that far, it would have lost money. If it would have been even, just not much closer. I had to move that far just to make $175. That's a disappointment. So combined, $57.50 plus $175, $232.50. So this number here is 232.5. So we made $232.50 yesterday, but really we would not have put that on with real money. Really what we made yesterday was $57. And that is amazing because that market closed outside of our cone of probability and we still made money. All right, we haven't filled this in. Did we make money here? No, we lost. We had a losing day on that day. So we have to put in a marker here. Fill that in with red. Pink. And then this one here, we had a red. Or no, that's a green. When you win, it's green. Oh. That's right. We hit our daily goal? We did. Okay, Thursday. That's today so far. And we're not done trading yet today. We might go do some day trading, right? So we're gonna save that. We're not gonna fill in our color code yet. And I fixed this sheet so all these are right, and then I updated the sheet out on the Pit News magazine. So if you want to go download this new sheet, it's been repaired. So so those of you who are subscribers to Pit News magazine, you get this spreadsheet with updated with every new issue. Right. So every time there's a link in the email that comes out that says, here's the spreadsheet. So you can have this spreadsheet. So you just have to be a subscriber to Pit News magazine. You get this spreadsheet. All right. So that's how everything's coming out. And the spreadsheet's kind of cool. I mean, it goes back and shows everything we did in May, April, March, February, January. But that's not the point. I'm not trying to just say, hey, look at all of our trading and let's go look and look, which is nice, though. You can come and see what we did. You know, you can look at all the notes and you can see all the things that we did and what made money, what lost money, how we lost money. You know, that's fun because you get to see the journal. So you go read all the journal entries. But what's more important is you can take it and clear out all my numbers, and then you can use this for your own journaling. And if you're not doing this, if you're trading and you're not tracking it like this, you're just blowing in the wind. You know, you're just blowing in the wind. You're not a trader. You need to track your trades. Hey, that sounds familiar. Track and trade. Oh, yeah. Wonder where we got that term from. So, oh, look at the Dow. It's gone clear off the screen. Man alive. Are you guys trading the Dow out there? Okay, let's see. Let's read the notes. I need to pay a little bit more attention to what you guys are saying because you're adding to the conversation while we're doing certain things, and I should pay more attention to that. Because then I come back and read the notes later, and then your comments don't make sense. I'm like, what were you talking about? So I apologize. Let's come in and say hello to some people. All right, let's bring this down here. So we got Bruce saying hello. Bruce coming in number 1 today. It's nice to see you, Bruce. Bruce, I answered your question out on Bruce made a nice comment out there too. So I wrote to Bruce on his comment. You can go watch. You can go. If you guys are not checking the comment section, you need to go check the comment section of these videos because that's where we have the conversation where you can ask questions after the fact. And I answer out there. That's, you can send me an email and you can say, hey, Lan, I got a question about what you did on today's video or in today's class or something. And you can send me an email and I'll answer it if I see it. But I get like 10 million emails a day. Actually, I don't think I get 10 million. I probably get 42 million. No, that's probably an underestimate too. I probably get a gazillion emails a day. And so if you send me an email and I see it out of that gazillion emails a day, then I'll answer it. But I get a gazillion emails a day. How many emails do you guys get? I just stopped looking. I don't even pay attention to email anymore. So email to me is where I don't have email. I mean, you can look at it like that. Land doesn't have email. Why? Because he gets a gazillion emails. So he just stopped paying attention to it. All right. So if you want to send me an email, I'll try and answer it, but it's better if you answer it out in the forum on the videos. And I appreciate it when you do. Go out there and let's have a conversation about what happened. And so go read the comments that have been out there because I make them quite detailed. So good morning, Bruce. Good to see you. Great to have you in class. We got Michael Bruce saying hello. Michael Bruce coming in number 2. So Michael Bruce gets the silver today. And we got Mark Boucher. There is a song. So I started singing a song. Thanks, Mark. Maybe you can sing it for us. Trooper, 2 for the show. 2 for the show, 1 for the money. Let's get ready. Let's go. Something like that, right? I don't remember. 1 of the money. Mark did sing it for us. 1 for the money, 2 for the show, 3 to get ready. 3 for the lady on the radio 4. Might be the one you'll never know. You'll never know if only there was a better way to go. Way to go, 2 for the show. All right. I asked Mark to sing it for us, and there he goes. Gives us the lyrics. And even I sang it for you. How about that? Bonus. Rock Steiner coming in saying hello. It's great to see you, Rock. We got Alex Katz coming in. Alex Katz saying, can you tell us how much you risk each position? Thank you and good morning. How much you risk on each position? Yes, let's go talk about that. Let's come down and see what everybody else is saying. And then we'll go back and talk. Unlike me, day trading and losing money have had hand over fist first week. This week, I'm making money hand over fist. Awesome. What did you do to change? What did you do to change to go from losing money hand over fist to making money hand over fist? What's the difference between this month? Is it you? Did you change anything, or is it the market? Because the market this week has been fantastic. I mean, look at that Dow. The Dow has just been jaw-droppingly wonderful this whole week. So the question is, Michael Bruce, you were losing money hand over fist. Now you're making money hand over fist. What changed? Was it you or the market? And if you say, well, I didn't do anything different, my strategy is the same, Lan, the market's just been performing better. That is a big lesson in itself, right? That is a fantastic, great, wonderful lesson in itself. So that's where we go back to that skew in the VIX. And if you go back to the VIX is rising and the volatility is going up. So when the volatility is low, clear down on that VIX. And if you haven't watched the VIX video, go watch it. I'd pull it up right now, but I have to go in, get the software, open up. It'd take me a few minutes to pull it up. And we're all familiar with the VIX because we watched the video VIX. If you haven't watched it, go watch it, or you're familiar with the VIX. The VIX is a volatility scale, and it goes up and down. So when the VIX is very low, that's when we want to do all of these neutral option strategies, right? When the VIX is high and rising, that's when we want to come in and day trade, because that's where we're going to get the nice trends in the market, and the market's moving and making nice trends. So if Michael Bruce comes in and says, hey, I'm making money hand over fist this week, but I didn't change anything. The market changed, all right? So being mindful of that can be a big lesson in itself. Hey, when that VIX is high, I'm going to make a lot more money in my day trading. When that VIX is low, I'm going to make a lot more money in my neutral option strategies. So I can go back and forth between the two. And you can have, that 1, 2, 3 knockout punch strategy. All right. So Kirk saying good morning. Rock Steiner saying good morning. We got Gary Thomas saying good morning. We got Mark Boucher saying awesome. Okay. We're going to come back to Alex Katz's question. And he says, can you tell us how much risk each position? Thank you and good morning. So the risk is the premium that you pay, but we're going to buy and sell. So we have an offset there. So let's go put one on. We're right at the money. Let's go put one on, okay? Neutral option strategies, and I'll show you what the risk is. So we're going to put one on. Let's put one on for today. And we're going to put on the one that we learned yesterday was the best one. We're going to try it. We're going to try it the rest of this week and all next week too. We're going to try this thing all the rest of the month. We're going to do this, all right? We'll make some minor adjustments, but I want to test it for Pit News Magazine. I want to tell you what the results were, and we're going to document it, and we're going to tell you and show you how we got there, all right? So we're going to come in, and we're going to go to we have to put the insurance policy on first. So we're going to go to 1 day. Now, I don't think today's going to be an aggressive day, so I could go out farther if I wanted to, but tomorrow's Friday, and I don't want to go over the weekend, so we're just going to do 1 day. Remember, we talked about that. So now I'm going to come in here and I'm going to sell both of these at the money. So I'm just going to come in. I'm going to sell my option premium. I would like them as close to the VWAP as possible. That's as close as I can get, and that's right where the market's trading. So that's my call. And here's the put. And there's a put skew in here, but it's a reverse put skew. So we're going to buy this one. Oh, and we're going to sell this one. Did I sell that one? I did. Okay, so we're going to, oh, no. Can't sell. We got to buy. Buy first. That's why we're on 1 day. So we're going to buy. And I'm going to buy it. Oh, here's the switch up. We're going to buy it in the money. One minimum move or one strike in the money. So I'm going to buy that in the money. So it's got a delta of 56. And I'm going to buy my put. I'm going to buy my put 1 in the money. So that's got a delta of 52. 52 versus 56. Okay, so that's in the money. So now I'm going to actually, should I put them on separate tickets? We don't have to if we're going to keep it the entire duration. We could come in here and we're going to I want to do it anyway because I want to watch and see how they go. So we're going to go ahead and it's supposed to be used 45.75, 45.75, 45, 46. Let's see if they'll give it to us. Okay, so we got that one. Now we want to sell. Now, what was the cost of that? So Alex is asking, what is the cost of doing that? So we bought those. So the cost of that was the premium that we paid, $2,275. But it's got 1 day till expiration. So it's going to hang on to its theta. We're not going to lose that $2,275. We're going to lose a little bit of it. And that's the idea, right? We're not going to lose very much of it because that's why we pushed it out an extra day. So they're going to hang on to that theta. That theta decay is going to be very small. We're going to get most of this back. Okay, because what we're going to do now is we're going to come in here. We're going to put on the other leg. So we're going to come back over to our options and go back to our options chain. Now we're going to go into a 0 days till expiration. And what we're going to do is we're going to sell, or we're going to sell these right at the money, right on top of each other. We're selling both of them. See that? And our premium collection on that, they're going to give us right now, boom, right now, they're going to give us the value of those $900. So now we're going to go ahead and we could bid for it, but we're in the demo account. I'm just going to go right to the 1775. Okay. So there we go. So that is our strategy. We're going to run this. So the cost of that, putting that on, is the difference between what they gave us. They just gave us $900, right? Because we sold these two options. The minute they give you sell two options, they give you that premium, and our premium was $1,000. So if we come over to our positions now, we see we have two tickets. I did it on two tickets on purpose because I like to break them apart. We can put them all on the same ticket if we're not going to liquidate at 25%, right? Generally, we'll liquidate these things at 25% when we have the wings that are out, the outer delta wings. But we're doing in the money delta wings this time, and we're going to hang on to those for the duration of the day. So there's no reason we don't have to have them on two separate tickets. But if you put them on two separate tickets, it just it facilitates selling your wings without having to sell your outer wings. All right, or liquidate. I shouldn't say liquidate. But we can liquidate those without having to liquidate these. That's what that facilitates. So now our cost of doing business. So our cost of the options that we bought was $2,275. And again, because it's 2 days and we're going to liquidate this today at the end of the business today, we're going to get most of that back. It's just an insurance policy, and we might even make money. If the market runs, it might even be profitable because it's just an in the money, right? Because we put it on two separate tickets. It's just it's an in the money straddle. It's an in the money straddle. And then this is an at the money strangle, right? So we're selling a strangle and we're collecting $897. That's why that's a negative number. Why is it a negative number, Len, if you collected it? And this is a positive number if you paid it, because this is your cost basis. So it costs us $2,275. But this is a negative number because when it's a cost basis and it costs you negative 1.8, it's two negatives. It costs you negative $897, which means they gave you the money. Okay. So we got $897 and we paid $2,227, and the combination of those two in there. And the reason we have to put on the insurance policy first is because if we sell the premium to collect the premium without having the insurance policy first, they're going to charge us a huge margin. So we buy the insurance and then we put on the solds. That makes it so we have a small margin. And then we also, the problem with having, the reason I say we're going to get most of this 227 back is because if we liquidated right now, we'd have to give most of this that we received, 897, back. So it goes back to, again, if you have your accounting, right, is that little T-square. Remember in accounting, you have a T-square, and this is your credit side, and this is your debit side. So you have credits and debits. So when they give you the 895, 897.50, 895, that goes into your credit. So you have $895 on your credit side, but you also have on your debit side, you have $895 too. So you have $895 on both the credit and the debit side. So it's really, they give it to you, but you still owe it. Just like the cost side, you paid it $227, but if you liquidated right now, they'd give you all of it back except for $25. Right? So it's not really costing you $2,275. It's not costing you $2,275 because you're going to get most of it back. Just like on the 897, they gave you 897, but you don't get to keep all of that. If you liquidate it right now, in fact, you're not going to get to keep any of it. They're going to make you give them $15. So this is $890, is actually $905, right? On the debit side, you actually owe them $925 against your credit side of $895. So that's how that works. And then the way you get to keep this money, this $897, is through the time decay. So the time is how they give it to you. And if you come over to your options chain, you see how much they're going to give you. Premium per day. We can go to the 1 day and it'll show you on that column. So the premium per day, you can see, and we just do the calls in here. We'll just do calls. This is how much you're going to make or lose per day, because it's 9. Well, you only have, let's go out to a 15-day option. So see that? It's $2,257 is what you pay for a 15-day option. You're going to lose $150 a day. That's what that's telling you. So it's basically 150, 2,252 divided by 15 days is 150. And that's, again, that's a linear curve. It's not it's not the exact number. It's a little bit different than that. But that's because of the time decay, right? So once again, just to show that very quickly, that's that time decay thing we keep talking about down here in the options section of our spreadsheet, of our slideshow. These are all the slides I use right here. So this is your 7.5 hours, 5 hours, 3 hours, 1 hour, and that's the time decay. And that's how you end up getting money. So they give you $895, but if you owe $895, you didn't really make anything. But over time, this $895 that you owe will go away. It'll go 700, 600, 500, 400, 300, 200, 100. And then that's how you make money. It's just letting it sit there and decay in time. And it goes over. And the further you get into the day, the faster it decays, right? You get more money in the end of the day than you do at the first. They don't give you very much money at the first of the day. But once it gets towards the end of the day, man, they give you lots of money really fast. So that's why sometimes you can wait and not put these on until 2 or 3 hours, put them on at noon. And for the last 2 hours, bam, 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 it'll drop really fast. Problem is, you put it on at noon, it'll only be $300, right? Because it will have already decayed the other $500 throughout the morning session. So now we come in and we say, all right, well, what's our cone of probability? And that's where we have to draw the cone of probability. And there's our expiration. Let's bring this up just a little bit. So we say, okay, where do we make money? Where do we lose money? Where do we lose money? Well, with this insurance policy that we're working here, the goal is to reduce the amount of money we lose, even if the market leaves our cone of probability. So how do we know our cone of probability? We come back to our positions. How much did we pay for it? $897 times 2 is roughly 9 2 9s are 18. So we got to go $1,800, right? So, but we're going to go outside. So it's going to go up here. If it goes outside $800, 897 up here. 897, $900. And then we're going to draw a little box in here just to make it easy. 897. Okay, and then we take our cone of probability right here, and we say from here to here to here. If it ends up inside that green cone, we're going to make money. If it's outside the cone, we're going to lose money. All right, and it goes back to the article in Pit News Magazine where it's this picture right here. Right, that's our cone of probability right there. So this is a pretty cone because it's all got all the numbers and everything. It shows you how much you're going to make. So it's got, you can see as you go farther outside the cone, it's not very much money, right? If you go all the way inside the cone, this is where you get 100% of your profit. In this, you get less and less, okay? And this here is where you're going to get it at the beginning. And then this is why this is good, because it covers this little green spot here that's loser. But then over here, it's like this. Now, this is if we do it at the money. I haven't done one of these little cones of probability in the money. I'm going to go do that, and that'll be in the Pit News Magazine for this July issue. But that's our cone of probability. And again, this is what it looks like over, but this is if you only did one side of the cone. So you still have green, even though you only have one of the option sides. This is called a put credit spread or a call credit spread, right? We call them chicken wings. So, Michael Bruce, when you put on a chicken wing, this is what your cone of probability looks like. Okay, even if the market goes a little bit against you, you can still make money. It has to go significantly against you to lose money. If it goes any bit in your favor, all it has to do is just go past the red line. You get max profit at the end of the day. That's why those are good. And then so if you do two of them, so this is just one, right? But if you do two, one put side, one call side, it looks like this. or like this, or like this. So if you draw it over the top of the chart, this is what it basically looks like. This is your cone of probability. So if the market is inside of here, right? So again, it's losing money right now because the cone of probability is really tiny at the very beginning. So that's why I kind of tell those guys that are trading this on those other YouTube channels, it's like, have patience, buddy. Don't get all nervous. Yes, it comes up here and you're losing money. It's showing you're losing money, and it hits their stop and they get out. And they're like, this stupid butterfly pattern doesn't work. I'm never doing that again. And then they teach a whole bunch of people on their YouTube channel not to do it, because if the market's inside of, outside of this cone, this is all loss. But it takes time for the cone to grow. And so if the market just sits there and does this, it's losing, and then it's making money. And if it ends up anywhere inside the cone at the end of the day, hey, you made a little bit of money. And that's the whole name of the game, right? Is make a little bit of money doing this. So you just have to understand the cone of probability, delta cone of probability. And the delta cone grows over the day. But it doesn't show that if you go and look at these little risk graphs, right? Because they draw their little risk graph and they see it looks like this, right? You've seen the little risk graph. But that's the risk graph at any given point in time. So they say, well, here's my stop and here's my stop. And if it leaves my stop anywhere outside of there, I'm going to lose money. Yes, but that's only at this point in time. That's only at this point in time right here. So you got your break evens. And so they're saying, well, if the market doesn't stay right inside of here, right here, I'm going to get out. I'm going to get out if it comes up here because it hits my stop. Well, that's because you're myopically looking at one single point in time. Stop looking at one single point in time and come down and think about the whole cone over the entire 7 hours of the day. So because your stop will continually move out here as the market goes farther and further out, right? And so if that market, even if it leaves it here in the first, it doesn't matter as long as it comes back into it out here. And if it doesn't come back into it, that's why we got this really amazing in the money insurance policy, which is going to help us make money if it's way out here. If it's way out there, we're going to lose money here. Yes, but we're going to make money out here, or at least enough money to maybe cover some of the losses, so it's not so painful. Does that make sense? Hopefully that makes sense. And hopefully that helps you answer the question of how much it's going to cost us. So at the end of the day, do we have to pay the $2,275? No, because we're going to get most of that back. And are we going to get the whole $897.50? Well, we could if it goes all the way to the purple line inside that. To get the maximum profit, it would have to be right there. And there's a little bit of a zone in here, some small zone like this, where you're going to get max profit. A little box like that, right? Where you're going to get max profit. So it's a kind of a little box, and you see that little box better on the Pit News magazine. See how you got this little 100% box. So you get your full premium in here. You don't get your full premium out on the edges, okay? And then of course, if it goes way out there, you're going to lose some money here, and you're going to lose some money there. So it's not going to be. It's not one number. That's the problem. All these numbers. So you say, well, how much are you losing? Well, at this point in time of the day, at this point it says it's $42, but here it's $75. If it's up here, it's at $58. If it's down here, it's at $66, or right here it's at $32, or up here it's at $27, or up here it's $64, or down here it's $77. So it's not one number. It changes throughout the day as time goes by, and you have these different numbers that you have to work with. So what we do is we generally do all of our calculations off of the end of the day, because that's easy, because everything's at a delta 1.0. The contracts are at delta 1.0. All the options are at delta 1.0. And so it's easy to calculate because everything's at 1.0. But throughout the day, the deltas are not 1.0. And so the deltas are continually changing. So the profits and losses are continually different. All right. So it's not one number. But we do know that the cost basis of this $2,227 that we paid is going to be relatively small today, because it's still got to uncover all day tomorrow till expiration. And so they hang on to and they maintain that value of that cost, and we get most of that back. And usually it's way less than a couple $100. So that if we make $897 at the end of the day on the solds, and we lose $200 the insurance premium, which is pretty rare. Even if this thing goes right straight to here, it's generally not a $200 loss, maybe, but then we still make $500, and that's on doing just one. And we could obviously come in and do more than one. We can, once we get comfortable with this and we feel, and we got a bigger account, we build it up and we do our risk management. We're doing a 1% or 5% of the overall cost of our account. We do all that stuff. We want to make sure we're taking all that into consideration. I don't mention it every single time we do it because we've mentioned it in previous videos, but we're testing now. One is the smallest value. We could do 10 of these, and then you'd make, if you're making $500 in each one, you do 10 of them, you're making $5,000 in every day if you feel comfortable with it. But you got to have an account size that'll accommodate that, so that you're not taking more than a 5% risk on any one trade. So that's how you have to work this out. And we talk about risk management, and that's all in that little spreadsheet too. So we've had that. And so that's what this is. So we got all that stuff in here too. So if you want this spreadsheet, it's free. All you have to do is just scan it right there, and it pops right up on your screen. This is just the notes for our class. But if you just scan that little scan code right there, it'll pop up on your screen. So that's how you get this. So you can follow along with us. When I pull up these slides, you're like, hey, I would like to have your slides, Lan. Just scan that little code right there and you'll get the slides. Or if you don't have a scanner, how do you scan, Lan? You pull up these funny little things. Most of us have these. They're called cell phones. And if you have one and yours has a camera on it, mine has a camera. I got this iPhone thing, and you click the little camera thing and it's got a camera. And if you point the camera at the computer screen on that little square right there, and then you're not taking a picture, you just point it at it, and what it does is it comes up and it puts a little yellow box on the screen, and you touch it, and it's a little screen, and it pulls it up, and then all I did, there it is. See that? Now it's on my phone, and now I can follow along. I can say, oh, Lan is on that slide. I want to see this slide, and you can just scroll down on your phone and see the slides. You can see the slides that are in this document online, and you can follow along. All right. So if you want to have that, you can have that. Now, this is the slides for the class, but they are the supplemental. They are the supplemental to the online book, right? Now, don't forget the manual to the class is on. You go over to Amazon and pick it up. This is a 220-page book, which is the manual to this class. It's called the Stock Market Playbook of Strategies, 220 pages. It teaches you all this stuff. It's all outlined. It's all documented. All these are is just slides out of this book. For the most part, these are slides that supplement this book. So now you got the slides. You just got to go get the book. Go out on Amazon, pick up the book, and it's like, what, $30, $37, something like that. It's not like a $200 book that you have to buy. It's just the manual to the class, but it's 220 pages, and it's got all the documentation for all this stuff that we talk about in these slides. So that's the manual to the class. These are the slides for the class. And then Pit News Magazine is the supplemental of the documentation of what we talk about in each individual class. All right. So it's kind of a three-step thing. You come to the class here on Pit News Magazine or on YouTube. You pick up the slides over here. And then this is the slides for the things that we teach in the class. And you just scan that. You got the slides. And then you go subscribe to Pit News Magazine, which Pit News Magazine is only $1 for 3 months. So you can get the first 3 months of your subscription for $1. So if you want all that documentation on the Wild Eye Crazy Eye, go get it. Go subscribe. It's only $1 for 3 months worth of this magazine. If you like it, it's $49 a year for a subscription. If you don't like it, cancel. And you paid $1 for 3 issues. So that's the way it works. All right. And it's even got audio so you can listen to the articles, and then you can read the articles. And sometimes we'll even put video in there so you can watch the articles. But mostly the videos are over here in YouTube. All right. All right. So on this strategy, there's nothing else for us to do but sit on our hands and just wait for that market to close out inside that green box. We want it to get all the way over here. The longer we wait for it to get to that, the closer it gets to that purple line inside the box, the more money we make. If it comes into the green box and you get out right there, well, that's where you're going to stop your profits. You're going to give up whatever else might have been out here, right? Whatever profit, but you took it right there, and you say, well, I took off $100 right here. Okay, great. Nothing wrong with that. You made $100. All right. If it's $100 against your cost of your DK on your your long insurance premiums, which right now you can see are only down $50. Let me move me again. I wish that would work. I could go up there and then, but now it's not showing the screen. All right, I'll figure that out. So that's where you could take it off. You could take off your $100 early, and that's what we do sometimes, right? We'll say, oh, take it off at 25%, and it takes it off right there. Oh, I want to take it off at 35%. Okay, well, 35% might be up here, and it won't be as much money as 25% was here. But then you wait, and it comes back down, and now it's back here again. Now 50% would have been a lot more money than 35% or 25%, right? So depending on where you take it off is where you're going to make money at what time of the day. And if you take it off right there, that's max profit. Max profit right there. Dead center on that line. Boom. Max profit. Anywhere along here, up here, might be a little bit less, might be a little bit less, a little bit less, a little bit less, because the opposing order is going to lose some, right? It's not going to give you the full profit. But the other order will. So it just depends on where you can take your profit at. And how much you're going to get back from the premium here on the cost basis versus how much you're going to collect on this basis. So total, as it goes through price and time, as it comes out here, this number combined should end up being a profit, and you can take your profits at some here. And again, that's what that table's showing you over in Pit News Magazine. All right, guys. Does anybody have any questions? So Alex Katz, I know. I know. I say a paragraph when a sentence will do. So yes, what I'm saying is you need to get a subscription to Pet News Magazine. I know. I use a paragraph when a sentence will do. Okay. All right. Before we check out and let you go for the day, let's come back and look at the Dow. Boy, if we'd have been trading that, we'd have been rich beyond our wildest dreams. What a beautiful trend that was. Wow, that thing's beautiful. We could have made money hand over fist today. That's a beautiful market. Hopefully some of you guys were, while you're listening to me pontificate about Pit News Magazine, you were trading some of these Dow trends over here. Man, that's a beautiful trend. Look at that. Just from this one arrow on this way down. From here, just that one move right there was $225. And it just did it over and over. 1, 2, 3, 4, 5. Boy, there's 200, 200, 200, 2, 4, 6, 8, 10. There's $1,000 right there in that one downtrend. Even if you got in and out on each one. Of course, you wouldn't have made the full 1,000 because you have to give a little bit back, but you get the point. From this move here, from here to here, that's $225. Back up, going from here to here, that's $190 to $150. Wow, that's a beautiful market, guys. Even I could have probably made money on that one. All right, I think I'll let you check out. I am being a substitute teacher for Doc Brown today. He's got a channel. It's called the Stock Market Trading Channel, and he charges like $50 a month to be in it. And you go watch him, and he does kind of the same stuff that I do on YouTube, where he shows you, but he just does options on stock market. And I'm being a substitute teacher for him this week. Or he's on vacation, so he asked me if I would take over his class. So I'm taking over his class and teaching those classes. And I record the videos for his stock market trading class, and I post those videos that I'm recording. I post them on my YouTube channel. So I do the live stuff. I can also do a pre-recorded video, right? That's what YouTube is. You got pre-recorded videos is what most people do. And then some of us do live. I do live because I want to do the live markets with you guys. And then I'm now, because I'm doing these pre-recorded videos for Doc Brown for the next 2 weeks, I'm posting them on our YouTube channel. So you're going to get videos from me posted on the YouTube channel. I got another one coming in today. I'm going to go post for Doc Brown. And I also posted into my YouTube channel. So watch for that. You're going to get another video today of me doing the stock market stuff. We're going to go review the Jim Cramer email. You know, I'd like to do that once in a while. So we go see what Jim Cramer's emailing out. And so we go look at his stock recommendations, and we apply technical analysis to them, and we analyze them, decide whether it's something we want to add to our portfolio or not. And that's what the video was, or that's what the video is for Doc Brown's class. And I'm going to post it on YouTube today, and you guys can have that. All right. So, all right. I guess I'll let you go. We're down $5. So you can see that our insurance policy at this point is losing $50, but we're making $42 on our sold options. And we just want the sold options to outperform the insurance policy by the end of the day. That's the name of the game, right? Okay, guys. I haven't got anything else to say about that. All we can do is just let it go. Wait. We'll see you tomorrow, and I'll let you know how it turns out.